Matthew Tillett, lead fund manager for the Brunner Investment Trust at Allianz Global Investors. Are you ready to play the Edison bull or bear game?
I am ready.
Emerging markets.
Neutral.
Inflation versus deflation.
Bullish short term, neutral long term.
Oil majors.
Bullish.
Sterling.
Neutral.
US dollar.
Neutral.
Global v UK equities.
Neutral.
FANG stocks.
Neutral.
Gold price.
Bullish.
Value v growth stocks.
Neutral.
Bitcoin.
Bearish.
Virtual meetings here to stay.
Bullish.
The plant-based meat alternatives.
Definitely bullish.
Okay, very good. Is that because are you a vegan by any chance, Matt?
Yeah, I'm a little bit conflicted here. Yeah, because I am vegan and sort of quite passionate about this whole area. So yeah, I do think they'll definitely do well. I hope they'll do very well, but the valuations of some of these companies do look completely off the dials.
Yeah, it's a very attractive theme at the moment, isn't it? But thanks for playing the bull or bear game, Matthew. And I guess usual format. I'll ask you to explore a couple of the topics. Noticed a number of answers neutral, so let's dig into maybe one or two of those. Maybe let's start with global equities versus UK equities. What are your thoughts around where you're seeing attractive opportunities?
Yeah, so I think on this one, I don't tend to have, when people talk about, indices, like, I mean, the UK stock market it's not the UK economy. I mean, it's kind of quite a unique index in terms of, what's in it. If you look at those big companies that make up most of it. And I don't tend to have like a particularly strong view on the one index versus the other, unless it was, those certain sectors that made it up, that had a strong view on. I think what I would say though is that I think the companies that are exposed to the UK economy do look quite interesting to me. Certainly, that's an area that we have some holdings. I think for a number of reasons. I mean, we had the Brexit period, the 5 years from 2016 onwards, which kind of led to a real sort of just sclerosis in a lot of kind of parts of the economy, and that's hopefully going to go away now, and we'll see a kind of revival in activity. And then from an equity market perspective, there has been a discount applied, that's still there to some extent amongst domestically focused companies, and then of course shorter term, although our handling of COVID hasn't been great, the vaccine rollout is clearly going very well, and so you could see the UK economy actually recover faster than many other areres.
Yeah, and any names you could maybe allude to that have taken, you've taken advantage of that dislocation?
Yeah, one I'd highlight would be house builder Redrow. It's a company that we were buying last year. And housing is an area that so we identified quite early on as being an area that was likely to come out strongly once the first lockdown was ended. Just again, it's actually links back to what I just said, but partly to do with the fact that the housing market had not been in any way, shape or form bubbly before COVID. The transactions were quite depressed because of Brexit, and so there was quite a lot of sort of pent up demand anyway. And then you had COVID, and then you had all of the sort of working from home, the fact that the margin there are people kind of reassessing their housing needs and where they want to live, and so that's led to this this quite sharp rebound in activity, and you have very attractive valuations for much of last year, and still even today.
Yeah, and moving on, I guess, to another answer you gave on a very heated debate within the financial community at the moment. I guess inflation v deflation. I think you mentioned longer term, you're pretty neutral. How do you see those forces playing out?
Yeah, so I think in the shorter term, I can see why you would have why there is inflation coming through, because there's just a number of factors. I mean, you've got, first of all, there's just the annualization effect of a number of kind of commodities and input costs that have gone up in price a lot, certainly compared to where they were a year ago, but even actually in many cases compared to where they were before COVID. So that's going to feed its way through into the supply chains and ultimately end consumer prices. You've then got the pent up demand, which is clear and will come back when economies reopen. So that's a sort of demand push in certain areas. Plus you've got ongoing stimulus, monetary, and now this time around fiscal stimulus as well. Key difference to 10 years ago when we were coming out of the financial crisis, when we had austerity rather than fiscal stimulus. So you sort of factor that together, and you can see why there would be some inflationary pressure. The reason why I say more neutral longer term is because there are still forces working in the other direction. That many of these forces have been around for quite some time. You might be described as more structural in nature. Technology being one. Much of digital technology is deflationary. Think of all the stuff that free services that one gets over the internet. Demographics. It's not that's aging populations is generally not. That's likely to kind of accentuate the deflationary pressures. This certainly has done in recent years. So I mean, there are alternative arguments there as well. I guess sort of what I'm kind of more saying is I just I'm on the longer term view. I'm keeping more of an open mind. That's why I say neutral. I could see it working out either way, but at this stage, I think we need to keep an open mind.
Yeah. Okay, great. And value versus growth. Do you think we've seen a bit of a rotation into maybe some more value stocks? But how do you?
Yeah, so if you'd asked me this one 6 months ago, I would have said bullish value, just because of where we were. It was just things were so extreme, and it was just. I mean, something you didn't need to make. You could put in some really negative assumptions for a lot of the kind of values areas of the market and still get upside. Those, when you see that, it normally means that there's a snapback is likely to happen. But we have to be cognizant of the fact that we've seen, we have seen a really big snapback happen already. And if anything, what we've got at the moment is this slightly odd situation where the market's being driven by, on the one hand, some very kind of high octane, high growth, sort of almost concept stocks. They're not really the FANGs. It's the layer below the FANGs. The kind of Teslas and those sorts of companies. And then at the other end of the spectrum, you've got the kind of reopening companies, the ones that were very depressed. But have been on a tear since the vaccine news has come out, and in many cases, a lot of those companies have actually recovered everything that they've lost. Some cases trading above pre-COVID levels, which to me looks and of course they were the value stocks 6 to 9 months ago. Are they really value stocks today? I mean, I don't know, not necessarily. If anything, the interesting bit is actually in the middle ground now. Some of the more quality areas starting to look more more attractive. Sectors like healthcare, for example. Where valuations are really quite reasonable, but I wouldn't necessarily describe them as kind of value stocks. They're just good quality companies at reasonable valuations. So that's the sort of the area that we're more focused on now.
Okay, brilliant. Well, if you would like to hear more from Matthew and find out a bit more about the Brunner Investment Trust, then please do click on the link in the notes below for an interview I conducted earlier. It will delve into some performance, the investment style, and conclude on the discount to net asset value, which seems like a very attractive opportunity to potential investors. So that just leaves me to say, Matthew, Tillett at Allianz Global Investors, thanks very much for playing the Edison Bull and Bear game.
Thank you.